on balance, you probably think an official cash rate increase is coming sooner than what was previously thought.
Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 13th of April 2026. I'm Head of Research at Goodall, and today I'm joined as per usual by Chief Economist Kelvin Davidson. Kelvin, I think we'll briefly revisit the monetary policy review later on, now that we've had a few more days to digest it and track the market reaction to that decision to hold the cash rate at 2.25. But first, we did release the CCCI for Q1 last week. Do you want to go through what it told us, and maybe we can move that into a broader discussion about kind of that construction and development industry?
Yeah, it was, 6 of one, half dozen of the other in some ways. There was a bit of an acceleration in cost growth, and that was kind of a headline that was picked up by media. But the thing I also said to them, which some stories left off, was that it's still very low. So yeah, it's turning around a little bit, but cost growth is still very low. So the first quarter of the year, we saw 1% increase in the cost to build a fairly standard 3-bedroom, 2-bathroom, I think it's brick and tile, single-story dwelling. There's a big, long definition, but think of it as a standard house. Went up about 1% in the first quarter and up 3% from this time last year. So that was a wee bit of an acceleration from where it's been over the past sort of 2 to 3 years. But the annual growth rate on average going back to 2012 has been 4%. So we're currently sitting at 3. The average is 4, a wee bit faster than it has been, but still below that average. So I think really you'd still say that the cost growth is relatively controlled and fits with the big downturn that we've had in the construction industry. There's still some capacity out there. Obviously some builders have done it pretty tough, so those costs are definitely flatter. Our index is about 50% materials, 40% wages, and 10% other stuff, professional fees, consenting, that sort of thing. So that kind of gives you an insight into how the index is made up, or how it's comprised. So the materials do play a big role, but wages are a big part of it too, and wages in the building industry, I guess, are fairly flat at the moment too. So it all adds up to a fairly controlled picture. I guess in terms of different items, there was a bit of a lift in masonry bricks, 12% rise we recorded in the first quarter, 5% for wallpaper. I don't actually know how many people use wallpaper anymore, but obviously it's still a used product. 4% for LED lighting. So those were some things that were up, but also there were things that went down. Plumbing related products, PVC piping, bathroom fit outs. So there's ups and downs. It all averaged out to a fairly flat sort of picture, and as I say, fits with that downturn we've seen. However, I guess there's a couple of things that I got questioned about, and one was, but isn't the industry picking up now? And yes, that is part of it. So we've seen dwelling consents rise on an annual basis. We had at the trough, they're about sort of 34,000 going back 6 to 12 months. Over that more recent 6 months, the annual running total is now up to about 37,500. So the industry's picking up. It does sort of fit with that idea that we're just seeing a little bit more cost growth, but still relatively controlled. So I think, in the coming period, consents don't necessarily flow through to actual work, of course, we know that, but there is a pretty good pass through. So the fact that dwelling consents are picking up, the news is a little bit better, you would think that would flow through to more activity in the construction sector, which will probably flow through to a bit more cost growth as well. And then Iran. I mean, we talked a couple of weeks ago about that anecdote of transport costs already being passed through from some suppliers to the construction industry. That was the bricklaying industry. So you'd think that's probably got more to run for a while. Maybe builders absorb that in their margins, but they probably can't do that forever. They're presumably at some point going to pass that through to output prices. So there's probably some inflation in the pipeline here for the construction industry, both from a bit more activity, but also from the Iran situation. So this could be, the start of more to come. Still controlled for now, but definitely keeping an eye on those Q2 numbers. So I think that was kind of the gist of it.
Yeah, I think that covers off pretty much all of it. I just wanted to touch on a few things. I think when you had that chat with Gerard as well, that PVC piping, which I hadn't realised prior, was a byproduct of the petrol process as well. So that's likely to go up. I talked to a plumber last week. I was at the Urban Development Institute presentation, and he talked about once he sort of saw what was happening, they went in, stockpiled essentially all the PVC piping they could get so that they could continue to keep up with their jobs. So there's going to be that disruption. There's going to be some change to the cost of those items as well, even though that was one that went down in Q1. I wouldn't be surprised to see that spike back up in Q2 if there's some sort of supply issue there as well. So yeah, there's going to be some change. I think that's the key here, right, is that, yeah, this is for Q1. Yep, the Iran conflict started at the last day of Feb or early March. So, partway through the quarter, unlikely to have seen any change or major impact from the conflict itself and these numbers, but it certainly will come through in Q2. So, yeah, while it is a bit of a, we might now have seen sort of, 2 quarters in a row of, 0.9% and 1% growth each quarter, a bit of a turning of this, slowdown that we saw in cost growth. That turnaround's come now, and maybe it's really only set to get even worse off the back of the disruption caused by what's happening over there. Yeah, I don't think there's too much else. I'm just going to look through my notes and see if there's anything else we sort of hadn't touched on. Probably not. I think, yeah, just to reiterate, probably your point around consents increasing again, that feel of positivity in the industry, as I said, presenting on Thursday to the Urban Development Institute, people there certainly feeling that positivity, even in Wellington here. So it does feel like, there's some positivity coming through from that perspective. We've talked about it as well, the fact that first home buyers can, and certainly do take advantage of the exemptions from loan to value ratio rules to get into new houses. So that's keeping that demand support relatively high, I guess. And certainly value for money when you're buying new at the moment compared to an existing property, which might cost you more in the long run. It's certainly, as I said, another reason to be relatively positive there. And with consents running at over 37,000 in the last year, it's a pretty decent number. It's sort of in that middle of that level. We think that properties can, or that we can actually sustain and build that many, the capacity that we can actually build between 35 and 40,000. So it does feel like it's in a decent spot. That's not to say it's all fine. There's still going to be some stories of liquidations and difficulties in the industry. Don't want to deny all those. And also it's going to change regionally where, it might be a bit tougher in some areas. But in general, I do think it's actually, showed a very robust industry. And I think that's helped by stronger lending practices as well, both for for those construction firms themselves as well as the buyers at the other end. So yeah, it does feel like a relatively positive story, but no doubt it's still not perfect or not ideal, and you can certainly spin it the other way when you go, it's come down from 51,000, so the industry's been holed out. It's like, yeah, it's actually survived pretty well, and certainly much better than what we saw after the global financial crisis, down in the low tens thousands of consent. So yeah, I think we can take that as a relative positive. Anything else jump to your mind? Otherwise, Kelvin, we can jump to, I suppose, just a bit of a Reserve Bank focus this week. We can talk through any extra thoughts on the monetary policy review, the official cash rate decision, any market reaction, as well as the Reserve Bank data for mortgage lending for February, which I thought was quite interesting, just along what terms people picked in February or chose in that month. And yeah, I suppose any other thoughts on just wrapping up where things are at the moment with the, I don't know, supposed ceasefire in the Strait of Hormuz, but potential blockades from the US Army and all Navy and stuff. So yeah, as we sort of said last week, it's changing daily. But yeah, I don't know, leading to a broader economic chat, Kelvin, and we can see where we get to.
Yeah, so just tying in the CCCI to that OCR, all the acronyms in there, but just one thing to say about the CCCI is that when I say cost growth is still relatively controlled, that is growth. There's a difference again between the growth in cost and the level of costs, and people might hear me saying, cost growth is pretty controlled, nothing necessarily to worry about, and going, yeah, but it's still expensive. And that's right, you can have those two things at the same time. And I just looked before at how much our CCCI has changed over the longer run. The level of costs is still about 30% higher than it was in March 2020. So I think, you'd still say a new build is relatively, people are going to be looking at this going, it's still costing me a lot, isn't it? But the point is that the inflation rate is lower than it used to be. So it can still cost you a lot in level terms, but not growing as much as it was, say, 4 or 5 years ago. So just a wee distinction there. Now, in terms of what the official cash rate tries to do, and more broadly in terms of prices, it's targeting the growth rate, not the level of costs. So maybe that's a wee segue there. But yeah, in terms of the OCR last week, Reserve Bank commentary, Iran, I don't have a lot to add. It's just this ongoing up and down. Who knows? You think it's looking better, then it's worse, and oil prices are up and down. And I've seen the value of my Kiwi savers come back. So there must be some sort of optimism in there about this thing settling down. But yeah, then you wake up this morning and see that it feels like another escalation again. So I think probably nothing too much has changed in terms of the message. It's really just we kind of got to wait and see and hope it all calms down. I mean, just I guess the key thing we got out of last week was that on balance, you probably think an official cash rate increase is coming sooner than what was previously thought. Doesn't necessarily mean it's coming tomorrow or next month, but maybe just that sense that the Reserve Bank's going to have to get on top of this at some point. So potentially raising that official cash rate sooner than what was previously thought. But yeah, there's a lot of uncertainty around that, and people have to make their best decision in that environment. We just all hope it calms down. So yeah, not sure that adds too much to what we already knew.
Yeah, no, I think it's just a reiteration of the point we made last Wednesday, right? Which is, yep, they've firmly floated that there's upside and downside risks to the economy and to inflation. But on the whole, they expect that the more likely scenario is that the inflation does stick around longer, the medium-term inflation is too high, and they have to do something about that, and that they won't be afraid to move sooner rather than later to fight against that, and even if that's to the detriment of the economy, because the main thing for them is to get that inflation under control. So yeah, I still feel like that's the feel I got. I don't think there's anything that we really gained any more insight off the back of that following their press conference and then the coverage of that conference. So yeah, I think that's probably fair. Not too much else to add to that one. Do you want to take us through February's mortgage lending data then, Kelvin? I think we'd seen it for a few months now that we're obviously well off the trough of interest rates and no expectation about where they're going to go and how fast they're going to go and all those things that people are shifting from shorter periods to longer periods fixing their mortgage for. But the data itself's pretty interesting, and so worthwhile just going through that and any other commentary you've got off the back of that data, Kelvin.
Yeah, I think this is one of those ones where a picture paints 1,000 words. It's good if people can actually see it on a chart, just how stark this turnaround has been. I don't think me describing the numbers will quite do it justice, but
Well,
I mean,
we are
yeah,
we are a visual medium these days, mate. So maybe I can have a go at trying to get a chart come up about now, whether you're watching through Spotify or watching on YouTube. But if you haven't seen one, then it's because I haven't been able to figure it out. But carry
yeah,
on.
possibly we'll push the boundaries on innovation. Yeah,
Yeah.
I mean, but it's been a sharp turnaround. So even prior to this whole Iran situation and talk of earlier OCR increases, people were already anticipating that the medium term sort of path for interest rates was up even before Iran, and we kind of knew that sort of tail end of last year. I think the Reserve Bank kind of signalled rate cuts were over, and the next move would be up at some stage. So people were already kind of banking on that, and we've seen it come through in the mortgage lending figures. So people shifting out to longer fixed rates. When interest rates were coming down, they're all floating or fixing short. Reached that turning point, and now we're going back the other way to the point where, so we have February's mortgage lending stats. This is the last cut of February's numbers. They do sort of 3 or 4 different cuts and different breakdowns. This is the one relating to what the terms people actually chose. It's about 19% of lending in February was floating, so down quite a lot from where it used to be. 22% fixed for 12 months. Going back sort of a year or so, that figure was more like 40%. So that sort of shift of either going floating or fixing for up to a year, that proportion has really come down. On the flip side, people fixing longer. So I think it was something like 55% of new lending in February was fixed for longer than 12 months. And if you go back sort of a year or so, that was down at 10, 15, 20%. So there's been this flip side or flipping around of it really. And so definitely fixing out longer. The 2-year term is really, really popular. I've got the stats in front of me, I think. Yeah, 2 years. So in February, about 31% of lending was fixed for 2 years. So that's really risen pretty sharply in the past 3 to 4 months. So that's the most popular term. People make their own decisions about why that would be the case. So it strikes me as, it's got a bit of certainty, bit of flexibility too. You're not locking in for too long. I guess still relatively attractive pricing. I was looking at mortgage rates the other day, and The 1 year rate is still the lowest, and it hasn't really changed too much. So the banks seem to be competing pretty hard on that 1 year rate. The 2 year rates have gone up, so maybe the pricing on 2 year rates isn't as attractive as it was, but I think people are still seeing that as a decent rate. Well, they're obviously seeing it as a decent rate because that's what they're locking in for. And I guess just weighing up those trade-offs of you want to fix a bit longer but maybe not too long. So that's kind of what's going on. I suppose in people's minds is also just that hope that you don't have to roll over in 2 years' time at a peak. But you make your best decision, don't you? And you sort of roll the dice in some ways. So as I say, chart shows it really starkly. But there's been, after a long period of everyone floating or fixing for 6 to 12 months, now we've seen just pretty much a mirror image. People have stopped that and they're going out beyond 12 months, and that 2 year rate is definitely the most popular one at the moment. So yeah, and as I say, it was happening before Iran anyway. So that's people are anticipating that that medium term rise in interest rates. So trying to get ahead of the curve.
Yeah, as you say, like the turn really came off the back of November, and that last discussion and decision from the Reserve Bank, and then the clear message that that was probably the trough for the OCR, and so mortgage rates would adjust accordingly. And I think just on that point around 2 years, it does feel like just in general, it is that happy medium between getting some certainty for a while but not locking in too long. And I suppose all the conversations around what interest rates are going to do, all is pretty short-term stuff. It's kind of like, what can we see happen the next year or two? It's pretty hard to know what's going to happen in 3 years' time, right? Like, where's inflation going to be? Where's the economy? It's always that the Reserve Bank wants to see this OCR drift back to its neutral rate, wherever that is, and maybe that's a bit of a different figure now with everything else that's going on. But if that's 3.25, something like that, there's still a bit of a way to go. But, will they actually get there? Their forecast for inflation is always, coincidentally getting back towards that 2%. So whether that's overly optimistic or it's overly confident they can genuinely have control over it. But either way, it's pretty hard to see what things are going to be happening in 2 or 3 years' time. So that's why I think 2 years is historically, one of the most popular rates always over time. Either that or the 1 year rate seems to be what most people sort of choose between. And that's pretty much the case right now. I thought it was interesting to see the 3 years up at 10% right now as well. So 10% of people fixed for 3 years in February. A little bit longer. That was down at, less than 1% or 1%-ish at the start of last year. So, I can just show how much people are happy and willing to take on that little bit of longer period. Decent rates around that 5% mark look pretty good for that long term. And you get that certainty and don't have to think about it for a while either. And no doubt people are splitting across these terms too. It's not like they're putting all of the mortgage on one of these terms. They'll generally, split between them all. So you've got a bit of a shared risk across them all too. So I just think it's an interesting one. It does help you get in the mindset of those borrowers. It often backs up what we expect anyway. I mean, we were talking about it in November, and so typically people, started to switch around then because they did, see that things weren't going to get much better. So you might as well take a decent rate right now, and that's certainly what people have done. So kind of all backs that up, I guess. All good, mate. Well, I think that's all for the data wrap this week anyway. This week, I know we've got our buyer classification data now that Q1 has ended. We'll send that out in an article this week to media, so that'll be released in a couple of days to public. I don't think there's too many surprises here. First-time buyers have held relatively strong. Movers still seem pretty constrained, and investors actually kind of dipped slightly, but held pretty consistent with the previous quarter. So but there's some good detail in that pulse that you've written around some of the differences regionally. So well worth paying attention to that one once it's released. And we'll talk about it in more detail next week anyway. Anything else on your mind, mate?
Just to say on those lending figures again, we probably say it every time, but that's relating to new loans. So it is across house purchasing, loan top-ups and bank switching, so so-called loan events, not relating to all those people who are rolling off an existing 1 year fix or 2 year fix or whatever. What are they doing when their existing loan comes up for renewal? However, I suspect that you're facing the same incentives, you're facing the same interest rates, so I suspect that the new lending data will be a pretty good guide to what people are doing when they're refixing existing loans too. And I suspect a lot of people are shifting out to those 2 and 3 year terms. So there's a subtle definition there, but I think you can probably use these new lending numbers to infer what everyone's doing. Just a wee definitional thing there.
Yep, no, good call out. Good to always make sure those definitions are clear. So yeah, totally agree. And I'd like to say, why wouldn't they be representative of those others? I suppose maybe more new buyers would be going through a broker or an advisor, maybe. So maybe their behavior could be slightly different. Someone refixing their own mortgage can do it through an app. Maybe their behavior is slightly different because they might not take as much advice, maybe. But otherwise, it still tells us a big part of the big chunk of the market and partly about mindset. So yeah, still worthwhile talking about. But yeah, good call out. All good, mate. Well, that's pretty much us for the sort of property and economic chat this week. And I'll leave a link for the CCCI article on our website. So do go and check that one out and let us know if you've got any questions or thoughts or in the industry as well and you wanted to chat about that. But other than that, we can sort of get into any, I don't know, sporting or personal highlights over the weekend, mate. Saturday was a bit of a sporting extravaganza. Kelvin, how did you manage the TV screen time that day?
Yeah, a bit of a juggle. I mean, I think the highlight for me was probably kind of the value of taking it easy. You know, we're all so busy with stuff, and maybe my friends would say I'm a wee bit too much of a hermit, and sort of stay at home a bit too much. But I think there's value in taking it easy, and certainly that was a good thing to do on Saturday because I think I started watching rugby at 2:30, maybe even 2 o'clock in the afternoon. And yeah, we're still kind of going through 10 or 10:30. So so yeah, it's a bit of a juggle. But come on, these are first world problems. Complaining about trying to switch my TV channel between two rugby games, it was hardly much to complain about. So yeah, no, I enjoyed that, and the results mostly went the way I would have liked. The Canberra Raiders finally got a win. She was tense at the end there, but yeah, Warriors had a good one, so it was good, and we're halfway through the school holidays, so that's always a bit of a milestone too. In fact, we're more than halfway through, so yeah, feeling good, and I mean, gee, the weather seemed to have passed through across the North Island relatively without too much damage. So that's sort of one to be pleased about as well. So going good. How about you?
Yeah, nice one. Yeah, I mean, the Warriors certainly, that was just a good one. That was a huge one. I think they haven't beaten the Storm for over 10 years or whatever and gave them a bit of a hiding. So that was a nice one to catch up on later. Canes obviously did the business to the Blues here in Wellington, and that was top of the table clash. And Canes, by the sound of it, made light work. But I didn't catch any of that. I had my own football games. Winter football was back, and yet we were running around in 20 degrees on Saturday afternoon. Not that I'm complaining about that. It was a beautiful afternoon for some football. We didn't get the result we needed, so that's a bit of a frustration. But our first game, so I'm sure we'll ease into the season. Good fun anyway, and yeah, nice to sit around and have a quick beer afterwards as well as per usual. And then yeah, I was sort of back home and get myself sorted to go and catch Sublime in concert out at Brewtown and Upper Hutt. So yeah, for a sports-filled afternoon, I ended up not catching any of that on TV and just catching up on that later. And yeah, that was good fun, mate. Really good fun. Definitely one of those nostalgia concerts. And when those big songs came on, Santeria and Wrong Way and What I Got, those all went off, and it was good fun. And yeah, we managed to ship the kids off for the night too. So not necessarily as important as having the night off; it was having the morning off. Which was definitely necessity for me. So yeah, no, it was good fun, mate. And yeah, I certainly survived the first week of school holidays despite Karina being away for a large chunk of it too. So yeah, solo parenting and working at the same time can have its challenges and some late nights, but survived and got to enjoy my Saturday. So I suppose that sort of made up for it mostly. And yeah, settle in for week two, but both of us on board this week and yeah, be all good. But yeah, mate, I don't think there's. Oh, I didn't even mention the Phoenix, but obviously last week going on record saying the Phoenix might squeeze into the top six and hopefully face Auckland. It looks like it could be done now. Losing to Melbourne City last night, who were kind of one of our rivals for the top six. So yeah, can probably put them away now. We're not going to make the top six now, I don't think. And yeah, they'll just have to rebuild for next year. But certainly signs since Greenacre took over has been pretty decent. So hopefully they give him a longer term contract and with a full season he can do a bit more. But yeah, that'll pretty much do us for today. Anything else on your mind before I close us out, Kelvin, or any comments on those things?
No, there's always next year for sport, isn't there? That's the thing, True fan, you take the rough with the smooth. There's always next year. So, yeah, look forward to that one.
Too right. Yeah, and you didn't even mention the Crusaders lost, and I know that's not your number one sport or number one team, but that still gives me a little bit of joy to see the Crusaders lose. So I'll chuck that dig in there anyway.
Yeah, nice one. Yeah, look tight. But yep, I mean that's for me against sport. It's got to be a contest. I want to see tight games. One team winning all the time. Apart from the All Blacks, one team winning all the times. Never fun. So
Yeah.
yep.
No, bang on, mate. All right, well, I'll leave it to it, and you can go. I know we were chatting beforehand about the Masters is on right now, so you can go and check how McIlroy's doing in the Masters. But
Yeah.
no, that'll do us for our Monday morning anyway. Thanks as per usual for all your thoughts, Kelvin. I'll have our catch-ups on Monday, so I appreciate that. But just want to say thanks very much for listening. Please do get in touch with any questions or feedback you have on the podcast. Always keen to hear what's going on out there for you. But that'll do us for today. My name is Nick. He's Kelvin. You've been listening to the New Zealand Property Market Podcast. Mā te wā.